Welcome back to another explainer. Let's just cut right to the chase today, because we are diving headfirst into an intense tug of war that is currently ripping through the Q3 economy. If you've been casually skimming the headlines lately, you'd probably think things are moving along pretty steadily. But once we actually pull back the curtain, you're going to see a highly polarized landscape. We've got this massive artificial intelligence euphoria clashing directly against some very heavy macroeconomic realities. Here is our roadmap for today. 1. The Q3 market illusion. 2. The AI infrastructure divide. 3. Macro and geopolitical gravity. 4. Consumer and crypto wildcards. And finally, 5. Navigating the Q3 tug of war. All right, starting right off with Section 1, the Q3 market illusion, surface calm versus underlying extremes. Look at these numbers, because they absolutely capture the deception we're seeing right now. Broad indices look comfortably green, right? The NASDAQ composite is up nearly 3%, and the S&P 500 is holding steady. But contrast that with the heavy macro anchors. The 10-year Treasury just hit a massive 19-year high of 4.68, and Brent crude is up 24% this month alone. Meanwhile, highly concentrated AI winners like Microsoft jumping 15.5% and SanDisk up 26% are completely offsetting some brutal internal wreckage. Just look at companies like FICO dropping 17%. The broad gains are literally masking a wildly fractured market. So the crazy takeaway here is that despite all of these chaotic daily headlines, the broader market has effectively been completely flat. It's been directionless since early June. We are pegged at roughly the exact same overall level as 77 days ago. But underneath that flat line, the individual components are experiencing extreme, violent volatility. Moving into Section 2, the AI infrastructure divide, builders versus buyers. This Q2 earnings tug-of-war is fascinating. It basically separates the cloud hyperscalers, those massive data center operators like Microsoft, from traditional hardware vendors. Microsoft reported blowout results, boasting healthy growth in paid AI subscribers, and their stance on AI capital expenditures is totally uncapped. They are fully 100% committed. The market rewarded this with a historic 15.5% jump. Cloud AI currently reigns supreme. Now compare that to a hardware buyer like Apple. They had a much more mixed result. iPhone sales jumped 22%, sure, but their Q3 guidance completely missed estimates. Why? Because they're squeezed. Memory chip costs are surging, which is forcing these really reluctant consumer price hikes, and the market reacted by dropping them 7.2% post-guidance. Hardware is getting choked by supply chain friction. To put this massive divergence into perspective, Microsoft's blowout earnings and their growth in paid AI subscribers triggered the largest single-day market cap gain in U.S. history, $449.7 billion. Let that sink in. This massive leap totally squashed any lingering concerns that their infrastructure investments were going to outpace their ability to generate cash. And this perfectly highlights the totally divergent paths of the builder versus the buyer right now. Amazon, the builder, is pushing forward with immense force. They dropped $54 billion in Q2 capital spending, eclipsing their operating cash flow by $8.8 billion. Demand is so hot they've actually raised server rental prices twice this year, eagerly taking on debt to fund a massive $220 billion annual build-out. Conversely, Apple, the buyer, is totally trapped. They are paying significantly more for memory in the June quarter than they did in March. Memory demand is far outpacing supply, and it's pushing Apple's revenue forecasts well below the Wall Street consensus. But, this highly leveraged AI exuberance is actually incredibly fragile. Take a look at a recent $20 billion margin call that absolutely shook the market. Step 1, the setup. An AI-focused hedge fund called Situational Awareness borrows heavily to amplify their tech bets. Step 2, the trigger. Broader market dips put pressure on the fund's liquidity, forcing immediate margin call demands. Step 3, the liquidation. They are forced into a massive fire sale, dumping the bulk of their portfolio to Citadel. And finally, Step 4, the rebound. Once that forced selling clears, these oversold assets violently gap right back up. It's a stark reminder of the hidden leverage lurking beneath these specific tech bets. Further compounding this structural shift, AI is literally juicing business creation while entirely flattening headcount. Notice the stark divergence here. New business applications are rocketing upward while the intent to hire has completely flatlined. We are witnessing a totally new class of acquisition, where startups are buying up legacy software businesses with the explicit intent of replacing their workers and management entirely with AI. Founders are generating seven-figure profits over a weekend with 0 employees. The takeaway here is profound. Company creation is accelerating, but that traditional downstream benefit of job creation, that's been officially severed.
All right, Section 3, Macro and Geopolitical Gravity, the heavy forces pulling against the market. As objective analysts, we have to neutrally factor in 3 massive pressure points that are currently weighing on the market. First, we have what's being called Warsh's Wobble. Long-term borrowing costs are pinned at 1995 highs, following a pretty confusing press conference by Fed Chair Kevin Warsh. Second, the Middle East escalation. We've seen 67 ships attacked and 17 seafarers killed since the start of the Iran war, with U.S. strikes now threatening the crucial Strait of Hormuz. And third, the $50 million ask. This is President Trump's aggressive corporate fundraising blitz, managed by Meredith O'Rourke, noting direct requests for $5 to $50 million from corporate donors. All 3 of these act as a very heavy bearish anchor against any market exuberance. Meanwhile, middle power countries are quietly making massive moves. To avoid a U.S. and China dual hegemony, nations like Canada, Japan, Australia, South Korea, and the EU are actively tightening partnerships amongst themselves. And this is triggering a multi-year capital expenditure supercycle. At the very center of this is a massive $1 billion combined pledge from Australia and Japan. They are matching Australia's critical mineral wealth with Japan's booming industry demand. This is actively creating a new, highly lucrative supply chain purely for trade and defense, completely outside the influence of the major superpowers.
Moving right along to Section 4, Consumer and Crypto Wildcards, Surprising Momentum Anchors.
Who would have thought Gen X nostalgia would be an economic anchor? But the consumer economy is finding some unusual lifeboats right now. With youth drinking at historic lows, the hospitality industry is aggressively pivoting to Gen X. They're surviving by programming nostalgia theme nights that, thankfully for some of us, wrap up before midnight. And on the franchise side of things, a single blockbuster, Spider-Man Brand New Day, is projected to generate $200 to $300 million domestically just in its opening weekend. That alone is expected to single-handedly push August Hollywood revenues past the $1 billion mark. Flipping over to the digital asset space, things are trapped in a massive imbalance where regulatory friction is heavily outweighing product fundamentals. On the fundamental side, things are actually quite strong for specific models. Subscription services and USDC stablecoin income now make up a record 48% of net revenue. But all of that is being totally overshadowed by Capitol Hill and the Clarity Act. Everything right now hinges on whether this act secures 60 Senate votes. Failure severely pressures the space, while passage permanently insulates the industry from future White House crackdowns. Basically, policy is literally trumping product right now. Which brings us to our final act, Section 5, Navigating the Q3 Tug of War, the playbook. With these massive opposing forces laid out on the table, how exactly do we thread the needle for the rest of Q3? Well, despite this giant wall of worry, the 19-year high rates, inflation pressures, and the Middle East escalation, U.S. equities actually still have room to climb. Strong earnings growth and solid GDP from a really solid base. Add to that relative price-to-earnings compression, meaning U.S. stocks are unusually cheap right now compared to international markets, hitting relative lows we haven't seen since February. Combine this with historically cheap tech multiples, and we get a highly compelling RBC 12-month S&P 500 target of 8,150. But, and this is a big but, we have to stay incredibly cautious. Commodity trading advisors, which are essentially massive algorithmic hedge funds, remain net long. But if the market drops into the 7,310 to 7,320 danger zone, it hits a technical floor. Breaching that floor could trigger these algorithms to panic and become massive automated sellers right ahead of the traditional August lull. So let's distill all of this into a definitive playbook with 3 distinct moves. First, the geopolitical trade. You want to allocate to middle power, commodity, and defense supply chains, like that Australia-Japan Critical Minerals Pact we discussed earlier, because they directly benefit from this multi-year CapEx supercycle. Second, the AI infrastructure trade. Prioritize cash-generating cloud hyperscalers like Microsoft over hardware vendors like Apple, who are trapped by surging component costs. And third, the macro equity trade. Stay long on U.S. equities, targeting that 8,150 mark. But you absolutely must strictly hedge that 7,310 technical floor to protect yourself against algorithmic dumping. Ultimately, the data demands a choice. The broader indices might look perfectly flat, but the currents underneath are moving at breakneck speed. Will you trust the illusion of the surface calm, or will you use the insights from this explainer to actively protect and position your portfolio against the extreme friction brewing underneath?